This week, I'm breaking down how the data we've been getting may actually be showing we're heading for turbulent waters in the economy and housing market. That's coming up right here. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida. And on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome. And if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. By now, you've probably heard that the jobs report came out last week and blew expectations out of the water, which is good news, right? Well, I don't think so. And that's not the only good news that may actually be bad news. So that's what I'm going to be talking about in today's market update. But first, let's start out with the local market stats and see how those trends towards a balanced market, maybe even a buyer's market, have been doing. All right, so let's get into this week's market stats. I'm going to room myself again. So last week we had new listings at 787. This week, new listings for the Cape Coral to Naples area went down to 689. That's down 13% this week. We are actually starting to see things level off a little bit with the new listings. However, I'm going to show you the trend lines over the past several years to give you a better idea of where we're at historically. Solds went from 806 last week to 499. Again, this is a lagging indicator of what's been going on 30 to 45 days ago. So that's down 39%. That's huge. It's way down. Pendings went from 827 to 746. Pendings are a leading indicator. So that's what's going on in the market right now. That's down 10%. So that's still indicating that although the mortgage rates have gone back down closer to the 5.5% range, buyers' demand just really isn't there like it was over the last 2 years. Again, price decreases. Last week we had an all-time record of 949. That's down to 702, but still 702 is that's three and a half times as much as it was back in January and February. So moving on to the actual inventory breakdown. So the single families went from 4936 last week to 4929 this week. That's actually down 7. Again, keep in mind this is a snapshot of Monday to Monday, so it's just a 7-day week over week. Condos went from 2111 last week to 2145 this week. That's up 34. So we had a net gain of 49 last week and a net gain of 27 this week. Multifamilies last week went from 179 to 190 this week. That's up 11. That is also pretty close to an all-time high for the amount of multifamilies on week over week in any given week since we've been keeping track of the stats. And then foreclosures, we lost 3, went from 42 to 39. Again, not seeing a huge amount come on the market. Before we go into the the northern part of Southwest Florida, I actually want to touch on the historical data and just give you an idea of where the trend lines are and what we're looking at month over month. So this is for the past 3 years, and all these charts will be for the past 3 years except for one, and I'll indicate when we get to that. But new listings, as you can see, new listings from 2019, we're really hovering right around an average range as far as the amount of new listings coming on. What we did see, what was I guess really the big surprise during the the last 2 years was the amount of demand that we saw surge, not the number of new listings, which have really been staying right around the same as it has been for 5 years, really. So as you can see, over the last 2-3 months, we can see that the new listings coming on the market have still dropped off, but that's to be expected with where we are at in the actual annual cycle of the housing market. New listings historical, just to put it in perspective, this goes all the way back to 2008, 2009. So you can see in 2008, 2009, when everything was crashing, that's when we had a huge amount of inventory come on the market. But when we got down to the 2011 and 12 years, that's when the market started to level out again. And we see the actual amount of new listings staying pretty consistent all the way through, except for a drop off in 2017, which fell quite significantly. And then again in 2020 with the onset of the shutdowns. So, but other than that, the trend line has really been very steady for the last decade or more. Average sale price. So this is where we start to see some interesting things happen. Average sale price skyrocketed over the last year. And now we're starting to see it drop off over the last 2 months quite significantly. You're looking at almost $150,000 decrease in the average sale price. Now, if we look at the median, it's not quite as large, but we're also not talking about numbers in the 750 range, 780 range. We're looking more in the 4.5, which have dropped down now from 460,000 to 420,000. So that even the median sale price dropped $40,000 over the last 2 months. Closed sales, as you can see, dropped off quite significantly over the last 3 months. And that is because less people are buying. There's one, inventory has obviously been contributing to that, but rising mortgage rates, as well as the number of homes coming on the market, have also decreased the amount of closings. And then more recently, with buyers actually starting to cancel contracts, that's also been contributing to the number of closed sales decreasing. All right, moving on to the north part of Southwest Florida, Punta Gorda to Sarasota. New listings went from 2145 last week to 1818 this week. That's down 16%. Again, although this does look like it decreased quite a bit in new listings, this is just a snapshot from a Monday compared to a Monday. New listings actually did increase this week. Same thing, price decreases, 2703 last week, 2298 this week. The actual psychology of pricing has started to affect the market. It's hitting mainstream media now. So sellers are starting to become a little bit more keenly aware of the fact that the market has changed. And I believe that has to do with people starting to really price their homes a little bit more moderately and not really chasing after the higher and higher prices. Solds, 2031 last week to 1372 this week. That's down 33% again. And then pendings, what's going on in the market right now? 2131 pendings last week, 1932 this week. That's down 10%. So again, we're seeing the same trend. Buyers' demand is just not where it was before, and it's still falling. Inventory breakdown: single families 4016 last week, 4114 this week. That's up 98. And then condos 1406 to 1405, a loss of 1. So we had a net gain of 271 last week. We still have a net gain this week of 97. Multifamilies, we lost 3 from 76 to 73. And then foreclosures 31 to 32. That's up 1. We're also going to break down the northern part of Southwest Florida. So this is just a real quick stats breakdown. Active listings, as you can see, the 4 I have circled at the top: active listings, new listings, pending sales, listings sold. Active listings, so that's what's on the market right now, and that is up. If we're comparing it to to May, just a month ago. So keep in mind this is for June. June stats went from May 36% up in June. If we're comparing from last June to this June, it's up 39%. So active listings have definitely increased quite a bit, quite significantly. New listings, that is also up in both directions when we compare to just a month ago from May to June. That's up 8%. And then from June to June of last year, 15%. Pending sales also down. So that's telling you what's going on in the current market conditions. Down 10% from May, and then down 11% from last June. Listings sold also down 4% from May, and then down 18% from last June. So these two separate halves, the left half and the right half, are indicating that the market trends are still showing things are starting to shift towards a more balanced market at the very least. As we move on to the gauges, kind of the market activity charts, this is all of Stellar MLS. So this is 26 different counties throughout Florida that is being tracked here. But in June 2022, we were at 24,333 active listings. The average for 5 years has been 28,000. So keep in mind, the last 2.5 years, we've been seeing inventory decrease. So that is going to skew the numbers to the lower side on the gauge. But new listings now, we have a 5-year average of 18,600. In June alone, we're up to 23,000. So this is way up. As you can see, the needle's all the way to the right. So that's indicating that we're seeing a ton of new inventory come on, more than usual. And then as we look at the closed sales, that is, again, above average, not quite as drastically as new listings, but closed sales have been up, which is indicating what we've been seeing, which is the demand has skyrocketed throughout the last 2 years, more so than normal, which is what's contributing to the amount of closed sales that we're seeing when you compare it to the 5-year average. All right. Interest rates. This week we had them go from last week at 4.9% to 5.1%. So just up 20 basis points, right around 20 basis points, according to NerdWallet. According to Bank Rate, again, also up 28 basis points, but they have us closer to a 5.5% range. Again, these are just averages across the nation and not indicative of any particular region or area. So you definitely want to talk to your local lender to get the best rates and most current rates for your specific situation. Headline highlights. I got really five stories that I want to touch on because that's what I alluded to in the beginning of this actual session. But what I really want to look at is the five stories. One of them is coming from Redfin, the first one. So this is the housing market update. And what I said last week in last week's market update was the fact that mortgage rates have really been kind of controlling what's going on with the demand. So that's really been what's in control of how the market is, how the market's reacting, and what people are doing in the market. Mortgage rates fall to a 4-month low. So we saw them rising for quite a while. Now, over the last couple of weeks, we've seen them dip down almost into actually below 5% for a little while. They are back up a little bit, but the measures of homebuyer activity, such as online searches, requests for tours, and agents' help and mortgage applications, rose as mortgage rates fell below 5%. So, again, we're going to see these stats really get skewed by the fact of what's going on with the mortgage rates. And that's why I said it's so important to look at the 2 and 10-year bonds and what the Fed's doing, because the Fed is really chasing the bond market, but the bond market is the leading indicator. So if you are paying attention to what's going on in the bond market, you're going to really be able to tell what's going to happen with the housing market as far as demand and inventory. When money gets cheap to use, when interest rates go down, mortgage rates go down, sellers are more likely to sell because they know that they can get better rates and cheaper money to buy their next house. But they're also at the top of the market as far as price, so they know they're going to get top dollar. So that's going to make homeowners give them more of an incentive to sell, but at the same time, buyers more of an incentive to buy. So that is what could actually start to spark another really housing frenzy as far as driving prices back up again. Pending sales in July posted their largest decline since May 2020. Home sellers are also reluctant to enter the market, as I just said. New listings fell 11% from a year ago, the largest decline since June of 2020. Taylor Marr, there are deals to be had on some homes that have been sitting on the market with reduced prices. And if anybody has been paying attention or been using my website, you can check out the MLS listings directly. You can follow along and get the updates as far as what homes are getting price reductions and how long they've been sit on the market, which it's starting to get surprising with how many homes are starting to sit on the market for a much longer period of time. The labor market remains a beacon of strength in the economy. I disagree with that, and we're going to talk about that in one of the next stories. So, but that's really what's going on. The mortgage rates are, showing where things are going to be going in the housing market. Markets in a world of pain as most shorted squeezes higher while the treasury yield curves invert to grotesque levels. I'm not going to go through all these charts with you. We've been talking about the treasury yield inverted for quite a while now, and it's actually getting worse. So that's indicating the level of recession and possibly depression we may see in the future in the coming months. Stocks ground higher overnight. So this is according to actually as of yesterday. Monday, stocks rose quite a bit, but by the end of the day, they really ended up being flat. So there really wasn't much of a gain on the overall stock market. But another red hot, but far cooler than in recent months CPI. So they're thinking that CPI will be still hot. Core is probably going to be the same, or if not a little bit worse. Whereas the headline inflation, things like what we've been seeing, the gas prices coming down, are going to cool. But it's really the core inflation that the Fed is worried about. So that could continue their hikes. The 2s, 10s curve inverted to a mind-blowing, grotesque 46 basis points, the biggest inversion since the year 2000. If you remember, 2000 and 2008 were the last crashes that we saw in not only the stock market, but the economy. And it's set to blow that out of the water in the next few days as longer yields continue to sink. So Americans are putting inflation on the credit card. We've been talking about this for months now, too, over the since February. Americans have continued to hit all-time records and new records for the amount of debt being put on credit cards, which is not a good sign. It means that people are hurting. They're not able to keep up with the expenses of the average everyday things that they need. They're not just racking up balances on their credit cards. They're also starting to show more and more applications for new credit cards. So the Federal Reserve Bank of New York Center for Microeconomic Data shows a 13% cumulative year-over-year increase in credit card balances, the largest jump in 20 years. It stands at $890 billion as of the end of the second quarter. So I'm sure that we're going to see that head over or close to $1 trillion in the next 2 months. While credit card balances typically rise during the second quarter, the $46 billion increase makes the second quarter one of the highest jumps on record since 1999. Again, over 20 years ago. Americans are borrowing more, but a big part of the increased borrowing is attributed to the higher prices. And then this goes into the story that everybody is, touting. The U.S. job market, we saw an incredible rise and increase in jobs in the last report. Just to kind of put it in perspective too, we just got back to the jobs that we lost during the thing when that started 2.5 years ago. 152 million jobs in February. So we're up 32,000 jobs since February of 2020. So we're just over the break-even mark. So it took us 2.5 years to really regain everything. And even with that, this is the thing that I'm more worried about, is the fact that we just got back to normal. But I think a big part of that is the fact that more people are working multiple jobs now. So while we might have created 528,000 jobs, or there's 528,000 new people employed, it really could be just the fact that the consumers are getting more jobs. So now that they're working 2 or 3 jobs, those are really contributing to the fact that we've just gained 528,000 jobs overall. And I think this is where the numbers start to get skewed with the data we're getting. Yeah, there's 528,000 jobs, but who's working those jobs? Is it 528,000 different people, or is it really, 150,000 different people that are working 3 jobs? So if that's the case, then the economy is not doing anywhere near as good as we think it is right now. And that could be detrimental to how the Fed is gauging where we're at in the economy and what moves they should make next. I'll keep an eye out on the unfolding developments in our economy and hope you'll join me again next week for more housing market updates. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know, and don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools, resources, and hot lists. And if you ever want to connect or chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.